Hi guys, Alonso here. I want to review with you my play going into next week. I have an earnings play for you with Wells Fargo. So I want to show you what I look at and why I like it going into earnings. Again, this is for education and entertainment purposes only. Be sure to do your own due diligence, your own research before you commit into any trades. So with that said, let me show you the chart. So if I go into Wells Fargo, which now I can't click on, there we go. All right, let's look at Wells Fargo going into earnings, right? So I know it has earnings because I'm going to go to Wells Fargo. I don't know if you could see the little blue light bulb there. If I click on that, it tells me earnings on 4/14, which is Thursday, because if you know, Friday is Good Friday and the market will be closed. So Thursday is the last day of trading. As you can see, the options chain ends on Thursday. So let's take a look here. At the chart. Okay. Why am I getting an error now? Okay. Sorry about that. Chart. Okay. Let me minimize myself. All right. Let's look at the daily, right? 1 year, 1 day. I like to have several indicators here. I can make a video on that if you'd like to see it. But for now, let's look at the moving averages, right? I like the 100 and the 200. The 200 is in blue. The 200 is in white. The 100 is in blue. And if you have too many and you forget, you can just right click. You see the blue or turquoise is 100. The white is 200. Those are just the colors I like, my preference. So I see here that most of the year it's been pretty strong. It's been above the 200, but around February, right around the time we had this whole thing with Russia and Ukraine, you could see that it took a pretty big hit. And it keeps going around. It hasn't quite gone back up to its levels around the high 50s, the 60. But what I want you to keep in mind is inflation, right? In this high inflationary period that we're going through and interest rates will go up, who's going to benefit that, right? Think who's going to benefit from high interest rates? In my opinion, it's going to be the banks, right? They're going to be able to lend money and get a higher return because of the higher interest rates. Therefore, I feel good about, as a safety play, if you will, about the banks, the Wells Fargo, the Chase, the Bank of Americas of the world to do well in this environment. Obviously, the Ukraine situation threw a wrench in that, but nonetheless, long term, for the remainder of the year, I feel pretty bullish about banks. I specifically like Wells Fargo, and I'm going to show you why. Wells Fargo trades around this range, which makes it accessible for people with smaller accounts. And for those that don't have smaller accounts, it's not very capital intensive. You're able to use your money elsewhere if you choose to. So I'm seeing, let me show you one thing that I like to do here. All right, so let's look for the year, right? Let's use one of my favorite tools. We're going to go to drawings, drawing tools. You're going to click on this first percentage here, Fibonacci retracements, and you're going to click on the high number, which is 60.3, and go to the low of 39.06. I know it's a little hard to see, but bear with me here. I'm going to change the tool. Bring this down a bit. Okay. So here you see some levels, right? 46, 49, 51, basically 52, 43. So I don't see Wells Fargo moving too far below 46.9, if at all, below 47. Likewise, I don't see it really exploding. I think it's going to be range bound. And for the year, right? It's a stock that I don't mind owning. Keep that in mind. I don't mind owning Wells Fargo. So here is my play. Here's my play, right? If it's a stock that I want to get into anyway, I really like selling puts because it'll allow me to, one of two things is going to happen. I'm going to enter the stock that I wanted to enter anyway at a lower price, or I'm simply going to collect the premium. Both scenarios are really good for me. Keep in mind, learn from my mistakes. Only do this if you have the funds to cover. Do not sell puts, if naked puts at least. Do not sell naked puts if you don't have the cash position to buy them. You will find yourself not being able to manage them if the trade goes against you. What do I mean by that? Let's go into the trade tab. I'm going to show you, you could see the exact positions that I opened, right? I sold the 48 strike puts expiring April 14th. And what does this mean? I'm just going to do one to show you as an example, right? For 97, I sold it for a little more, but around this price. For $97, right? A collective premium of $97. And this is the worst that can happen, right? The max loss, 47.03, because I'm obligated to buy this stock at $48, 100 shares at $48, regardless of how low it goes. But again, since it's a stock that I want to own anyway, I don't mind that. However, what impact this is going to have on my capital, right? The margin requirements, as you can see here, it's only going to take $900, right? But in reality, the stock is going to cost me, if I buy 100 shares of them, 4,700. So if it gets to the point where I am assigned, right, if the trade goes against me, I better have these 4,700, or I'm going to find myself in a margin call, and you do not want to be in a margin call, because you're either going to have to take the loss, not be able to roll it over, not be able to manage it at all, or you will have to come up with the funds to fill it in. So if you only have for example, a $5,000 account, only sell one put, right? If you want to own Wells Fargo, just sell one put. So then if you're assigned at 4,800, it's okay. You'll just own 100 shares of Wells Fargo at 48. You won't have to manage or meet a margin call, and you'll still make $100. So I think that's the safest play. So do that. Don't exceed your margin requirements. Okay, so the other thing I wanted to show you was this, right? If it's something you want to get into anyway, you could just sell more, right? I happen to sell 10, right? And that's $965, but it's a stock I want to get into anyway. So if it's a stock I want to get into anyway, I'm willing to do it. I already own, just being very candid here, I already own Wells Fargo at 48.50. So if I buy more shares at 48, I'm only improving my position. I'm lowering my cost basis. So I'm very willing to do that. So keep that in mind, right? So I sold 10 out of the money puts at $48 strike price at 97 cents. So what does this mean? I'm basically collecting premium. If you look at theta, which is time decay, I'm collecting 11 cents a day, or $11 a day, right? Because it's 100 shares, $11 a day times 10. It's a pretty good day. And like I said, it's a stock I want to own anyway. So I'm not doing a play like what I did with Micron, simply because if you look at the volatility is not very high. So there's not going to be a lot of movement. You're not going to get that volatility squeeze to benefit from. So this is a straight put, just collecting the premium, and if I'm assigned, I'm happy to own it. Another thing I wanted to show you was, once you do it on the put side, right? You can also do it on the call side, and it's not going to take any buying power, because it'll only match or cancel out what you already have on the put side. So ignore this call, because I already have it, right? It's for shares that I own. But the second one is just to counter my put position. So what does this mean? So I have 10 naked put, cash secured puts, whichever one you want, at 48. And I look at the standard deviation of 2.7. So I sold 2 calls 10 calls at a $55 strike price. Is Wells Fargo going to go up 2 standard deviations from now until next Thursday? It's highly unlikely. Look at the delta. It's 0.05, right? But again, to my point before, I'm not exceeding my margin requirements. So if it goes to 55, 56, I'm going to be able to roll it out because I still have margin left. If you don't, just do one and you'll be collecting, 97 here and then 7 here, and that's 100. That's a pretty good return if you look at it from a return basis, right? So that's just one thing I want to share with you guys. It doesn't take, once you have a put position open, you can open a call position without taking away any margin. And it goes the other way as well. If you have a call position, you could do the same thing on the put side. So I hope that helps. And that is my play for next week. Like always, I'm trying to give you at least one play by week so that you guys can either paper trade it and see how it goes for you, and then you're able to manage it, or just you could get a better insight as to how I trade from week to week. So I hope that helps, and I'll see you guys in the next video.